Hey guys, welcome back to Chapter 15, Lecture 2, where we're going to be focusing on a lot of the economic side of this chapter. Last time we really focused on the idea of sustainability and the context of how is that good for the world or is it not. There's obviously different viewpoints, but we were arguing that environmental scientists are all about trying to find sustainable ways to do business and to create lives for people in a way that the future does not have problems that that they inherit from us. So we're going to use economics to try to analyze some of the costs of basically a progress of economic progress to the environment. How do we find a good solution to that? So we're talking about resources in economics, and they're scarce. We don't have unlimited everything. So depending on how much of the stuff we have, we might have a high demand for it, and if there's only a little bit of it, the price is going to go up because of that. So we're going to use basic economics and bring in externalities, other costs that we might not have thought of before. So let's start with supply and demand in the market. So in market economies, this is where we're trading goods, and we have pretty much open trade. So the cost of the goods is really determined by supply and demand for that good. So this is the basics of economics 101 here. So if we go back to this classic curve, supply and demand, and we also have price over here, and here's our quantity. So in general, if you look at these curves, obviously supply and demand are going in different directions. And price is always connected to that as well. Notice, let's say we have a really high price for a product. If that price is really high, well, it depends on the demand. If is the demand for that product going to match with the supply? It depends on how much there is. Notice if the supply is, or the demand goes down in this direction, the supply is going up in this direction. So if something's not scarce, that really is going to help determine the price. So if you notice what it says down here, it says a manufacturer will supply a certain number of units of an item based on the revenue that will be received. So that's important too. A manufacturer it takes a lot of money to manufacture more items. So the price has to be such that the manufacturer deems it's okay for them to continue manufacturing those items. So let's look at these definitions a little bit more in detail here. So supply curve shows how many units of a given product or supplier can make available. So if you are the only supplier, think about that. Let's say you're the only one that makes this product, and maybe like an iPhone, for example, and a lot of people want it. That's a condition of scarcity. That means demand is really high for this product, and you're the only supplier. So that means you're probably willing to make a lot of those units. If you're the only supplier and there's a really high demand, you are going to try to supply as much of those as you can because you're the only one that can produce it. However, we see that supply can change depending on the producers. If another competitor makes a similar phone, then all of a sudden you might not want to manufacture as many as you thought you would because the competitor will be taking sales. So you're going to start adjusting your supply because of that. So the supply number really depends on a lot of that type of stuff. It really does depend on how many competitors there are. It depends on the demand. It's all this balancing act. On the demand side, though, that shows you at that point in time how much a consumer might demand. And there's a lot of things that go into that. Think of, for example, the stimulus check that everybody got, or most people got in the US. There might be a demand for certain goods because of that. So their income has gone up. So if the income of the buyers is high, they might be more willing to buy more things. So their demand for certain types of products might be higher. Price of the good will start fiddling with the demand. So for example, gas, if we all of a sudden had a $10 tax per gallon, let's say the government is trying to reduce fuel consumption in the US, you can imagine that the demand for gas would go down if it costs $12 a gallon. Well, clearly that price is connected to the demand of the product. So that price can really help influence how much demand there is in a product. Also, simply just the tastes of your consumers might change. That can affect their demand, their expectations of the future. Maybe they expect the future economy to be down, or they expect that they're losing their job. That could affect their demand for specific products, and just the number of people. So it's not just these curves. The curves look so simple, but that demand line depends on a lot of different things. So if you look at that demand curve and you look at the price, this is one of the classics of demand, is that if the price goes up, typically, yeah, the demand is going to be decreased. If we go back to that curve for a second, notice demand versus price. We're just looking at price over here. Price is going to go up. Actually, this curve doesn't do a great job of showing that. But if price goes up, demand is going to go down. But that curve has too many intersecting things on it right now. But if price is going up, then yeah, the demand typically is going to drop. That is that inverse relationship that we see between price and demand. So price of good rises, the quantity demanded falls. So when the price falls, demand will rise. Price and demand are inverse related. We call that the law of demand, this little inverse relationship here. Now the law of supply, on the other hand, so when the price of a good rises, the quantity supplied of that good will rise. So when the price of the good falls, the quantity of that supplied product will fall. Price and supply are directly related. If a price is increasing, that means the manufacturer would like to sell more of them. So they would like to go ahead and produce more of that. But on the other hand, notice right now the price of a barrel of oil is very, 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 very low. And so you would think the manufacturers of oil would want to stop drilling because people are not wanting to buy it. So that price and supply should be directly related there. So what's the real world price, right? We're looking at a lot of extremes. Well, it's this inflection point. It's the point at which the demand and the supply kind of match in the middle here. This is the price at which the consumer is willing to pay and the price at which the manufacturer is willing to sell their products. So that's the intersection price. That's the price of a good at market, the natural kind of equilibrium point where the price matches with what the supply and demand is at. So that is our kind of in the middle ground where we actually see our products fall. And that's, all things being equal without any other externalities or other factors involved. So again, at this price, equilibrium, suppliers think, okay, this is worthwhile to make this many. It's exactly, hopefully, as much products as the consumers are willing to buy. So if the consumers demand 100 iPhones, the manufacturers will be, okay, I will make 100 iPhones. But that means we have to have a specific price, and that's where the price is going to be, where that supply and demand meet. So that's our equilibrium point. So why are we talking about all this supply and demand stuff? Well, the point is there are a cost. I will pay a certain amount of money, for example, for electricity, and there's a cost involved. There's a monetary cost involved. But what are the external costs, externalities, the hidden costs of buying electricity? It depends on where the electricity comes from. So externalities, these are the costs or impacts of our goods or services. In my mind, I'm thinking about electricity right now, on people and the environment that are not included in the price that I actually pay. So if I'm paying $50 a month, let's say $100 a month for my electricity, that's the bill that I paid. But what are the external costs that are tied to that electricity? What's going into the environment from my use of the electricity? So there's costs of using resources, water, air, land, or the oceans, for example. So there's costs of air and water pollution, or these waste products that we have to get rid of. There's these external costs that actually are not thought of when you actually pay that dollar amount for your electricity. So if we actually think about adding the externality cost to the true cost of a good, what happens is we're getting a more expensive product. So in reality, we should be shifting our curve. And this says it in words here. It says the equilibrium point moves up and to the left. So reflecting the increase in the cost of each unit. And there should be the corresponding decrease in demand. So think about this. There's the dollar cost, right? Let's say you have coal-generated electricity. So I'm using my electricity, but it's actually being generated by a coal power plant. So what are the environmental costs? There's all the bad emissions that are going into the air. Those can ultimately end up in our lungs. And healthcare costs, for example, might need to pay in the future. So we're going to pay for it some way, but we're not paying it up front. What that means is the demand for it is higher than it probably should be. Because if we knew, if we paid, let's say we pay $100 a month for my electricity, but they added in an extra $20 environmental tax, that's $120 a month now. I might not use as much electricity anymore because I know I have to pay $120. That will in turn help us use less coal and help mitigate some of these externalities. So that's an example how you might use a tax to suppress demand. So again, if you have this is your equilibrium point before, this is what the price should be. See, we're moving the price upward. And anytime we move the price upward, we reach a new equilibrium point. So the demand is actually here now. Instead of we want this much stuff, we only want this much quantity now. So we should actually decrease our demand. So if you use a tax system, for example, if we wanted to suppress the demand of gasoline, all you would need to do, again, there's other ways, but one way is you put a tax on the gasoline. A $3 tax per gallon. All of a sudden, if it's $3 per gallon, the next day it's $6 per gallon. We are pushing that cost to the consumer, and they're going to have less demand for that. And what that will do is have us use less gasoline and burn less and harm the environment less. That's one way you can think about that. But again, it's more complicated than simply taxing things. But that is one thing. So when you hear about something called a carbon tax, well, that means you're putting tax on carbon emissions. So companies are, looking to decrease their carbon emissions if they don't want to pay those taxes. So it's incentive to be environmentally friendly. So with all this in mind, the other way we think about the economy and the big numbers, the GDP gets thrown around a lot as basically the overall, success or wealth of a country. And it's the value of all products and services produced in a year. That's including things like healthcare services. So it's a little bit tricky to think about, does this mean the well-being of the company or the country overall is better just because they have a higher GDP? It's a little more complicated than that, especially if you think about a developed country. Maybe they have a lot of high healthcare costs like America. Our healthcare industry is massive and it's increasing every year. Is that good? You could argue maybe not, because why are we spending so much on healthcare? That does get tied into our GDP. And also the GDP does not reflect other externalities like pollution. Remember all those hidden costs. Those are costs we might see down the line in terms of economic costs and health costs, etc. This burden later on. So there's one way of thinking about it. It's called a genuine progress indicator. It attempts to add back some of those externalities into your global economic number for your company. So they try to put those in and adjust your GDP. And it tries to include, first of all, measures of personal consumption. So how much consumption is going on per person? Does your country have a equitable income distribution? Is the wealth, mostly at the put into the hands of very few people, given the population of your country? Also looks like, is there's higher education, is that important in your country? What percent of your population has a college degree, for example? And also just the health of the population, and that's included in the general, what we call this progress indicator. How is your resource depletion doing, your pollution levels? So all these things are trying to measure the overall, well-being and productivity and of your country, rather than just looking at value of all products and services. This is a very narrow view of, the wealth and productivity of your country. So what they found for the United States, or we have found over the years, is that our GDP has been, launching and rising and rising and rising. Our GPI per capita was rising with the GDP for a little while there. But now it's pretty much flattened out. After the 1970s, we have not really seen an increase in our GPI per capita in the United States. So I think that's something to be concerned about. Yes, our economic growth in terms of just, remember, value of all products and services, that's increasing. But what about all these other things? Is our levels of higher education per capita getting bigger? Is our income distribution getting better? Our pollution, our resource depletion, our health, are all of these things increasing? So again, these are all things that can be affected by these externalities that are not in the costs that we pay. So just like costs, GDP, I think it's a good idea to look at some of these other things, include them in your analysis. So we're thinking about developed versus developing countries. So there's this curve called the Kuznets curve, and it takes per capita income in a country, and it says that as your country gets richer, over time, first of all, as you produce more people, you get more money, your factories are going, your cars are going, you're going to have this big environmental degradation for quite a while. But then it starts to decrease. So, but this doesn't really apply to all situations, but let's just look at this curve here. This is the idea that as we get richer, let's say like a company like China, as they were starting to develop, cranking out pollution because they're really ramping up production and cars and all this stuff. At a certain point, at a certain GDP, the theory is now that we have so much money, we can start using that to use more expensive technologies or use it for research and development to find a way to help improve the environment. So, ideally, if we get to a certain point, we would get to this tipping point where we have so much money that we can utilize our resources, our higher educated population, to produce technologies that actually help the environment. For example, catalytic converters in cars, not the cheapest piece of equipment to put onto a car because they use really expensive metals like palladium and things like that inside to catalyze these reactions to help the emissions be safer. But once your country has enough money, we can start putting those in the cars and our environment starts to improve. Again, this is a simplified situation though. This doesn't always happen. You can imagine the population of your country getting so high, and what's to say that we don't use that money for those technologies? That's not a given. And also, the higher the population increase, the richer the people, the more babies they're being had, the more they're consuming, the more they're polluting. This could just keep going up, and we don't see a turning point. So this is a theory, but it is controversial because it's not going to apply in all situations. So that's really the developing country. We have a lot of money, but what happens to countries where you don't have this big boost in GDP? You never reach this tipping point. Well, then this section of the book goes on to talk about this idea of technology transfer, or leapfrogging. So poor countries, like some in Africa, instead of having this, this smooth transition or this gradual transition where electricity is here, they start building these grids and these networks, and you get this gradual increase in electricity throughout the country. These areas where there's no electrical grid, but we leapfrog the old technology by dropping solar panels instead. So let's say we're leapfrogging coal-generated power plants and electrical grid, and instead installing direct photovoltaic solar cells. And these are less environmentally disruptive. They're better for the environment. They just sit there. They don't produce any emissions. They're expensive, but this is this type of technology transfer that we can help other countries get to technological point that they need to be without doing a lot of harm to the environment. So this is a helpful way to produce these type of technologies in other countries. The other side of the developing countryside is this idea of microlending, and this was not really a thing. This was introduced by, we're going to see this guy's name, Dr. Muhammad Yunus, in 1996 or something, I forget. It says in the book, but it also says in 2006 he received a Nobel Peace Prize for this, for pioneering this idea. And it's this idea of you take these banks that their focus is specifically, not banks, but these lending organizations, their focus is to give really small loans, like $50, $300, $500 to someone in a developing country. And they can use that. They're buying inexpensive items, maybe to start developing a business. And they try to quickly repay the loan. And they get this cycle helps them because the lending agencies try to encourage, or there's certain stipulations on what they can use their money for, and say, listen, we're going to encourage sound environmental practices. We want you to develop technologies that are environmental friendly, efficient. So these companies are trying to both encourage people to start a business and help generate their own income, and also do it in an environmentally friendly way. So when you think if they're using their money to produce these goods and services in their local markets, that means hopefully that they're importing less things, so less fuel is being used to transfer. So that's a big, although seems small at the time, but that's an important environmental benefit. Sometimes they encourage them to focus on their current family and getting their current family at a level of sustainability where they can have their own income and everybody's healthy. That way they're not having too many kids at one time. So it's just this type of like education where it's trying to help them get back on their feet and produce their own business and also do it environmentally friendly way. So this is a pretty cool idea. I'm sure there's a lot of microlending agencies out there that are not very reputable, but for the most part, it seems like people agree that this is a good thing for a lot of developing countries to take advantage of, this concept of microlending. So that's the end of our discussion. Again, the big takeaways here is that supply and demand is caught up in the environment. This is really the important thing here. Understanding that this is our equilibrium point, where a certain quantity is supplied and demanded. And at that supply and demand level, it'll have a certain price. Let's say, again, coal-generated electricity. However, if we add in the external costs of coal, pollution and things like that, the trickling down of health concerns, things like that, the price then of the coal actually should be, or the electricity should be up here. And as we do that, the demand curve goes this way, and the supply curve goes this way. We should be supplying less and demanding less at this quantity. So there should be this much coal-generated electricity being used, and it should be costing a higher amount. So that idea of externalities should actually increase the cost if we truly consider them without, we don't want to ignore them. On the other side, the GDP, again, is really more complicated to say, is your country doing great? Just look at the GDP value. Maybe not the greatest way to look at it, considering our GPI has not really improved per capita over the past 30, 40, 50 years. So anyways, I hope you guys enjoyed that talk about economics. We're going to move on in the next sections and finish the chapter. Where is that? Here it is. We're going to look at economic systems, the fact that capital is natural, human, and manufactured, talk about laws and regulations, and then move on and think about how can we be good stewards and actually help be good stewards in the role of sustainable culture. So we'll talk about that next time. I'll see you guys then.